Good morning,
Good
everyone.
morning. Good
Good
morning.
morning. Yeah, my name is Adinkuye Uzochikwaloye. I want to welcome everyone to this day's webinar, today's webinar's meeting. And our speaker today would be Dr. Chioma Nwafo. And we'll be speaking about the COVID-19 induced challenge of managing corporate credit defaults, the way forward. As regards this particular topic, before we welcome the registrar to the platform, I would like to appreciate everyone that has been helpful in making the Institute move forward, for your contributions, and also to introduce the fact, to also inform everyone available that the Nigerian Credit Industry Award will be coming up shortly. So we would also want, we've been sending out circulars, we've been sending out newsletters, informing people, informing our members of the webinar, the Nigerian Credit Industry Awards that will be coming up on the 12th of December. So we are still awaiting responses, positive responses from the members. And I want to use this particular platform to appreciate our members and their achievements, their notable achievements in the line of credit. I would also want to welcome the registrar of the Institute in the person of Professor Chris Onalo to take over from here. You're welcome, sir. Good morning, sir.
Good morning,
Yes, welcome, sir.
Ujo. Good to hear your voice, and let me welcome everyone as well, all our members, distinguished fellows, members and associates of our great institute, and council members, my boss, who are present in this webinar this month for our members, and also to welcome more especially the speaker today, Dr. Chioma Nwafo. I've seen her face not too long ago, and I'm sure she's in the room. Dr. Chioma, you're welcome all the way from Glasgow, Scotland. Good morning to you.
Good morning, sir.
Oh, great. Oh, wow, you are looking like Angel. Yeah.
Really?
And that's how they took over the loose, right?
Thank you.
Please come over, come back home, Eh?
I'll be home for Christmas. I'm coming back on the 17th.
Okay, great. So let the African sun shine on you. And then when you go back, coronavirus in the United Kingdom will get scared, and people can get infected, from your power from Africa. Anyway, we are good to see you this morning. I also want to again go back to members of the Institute of Credit Administration. I'm seeing the number of participation is still a bit low, and I hope members will take advantage of this very special edition we're having this month, in which we are going to discuss the COVID-19 induced challenge of managing corporate credit defaults, the way forward. And Dr. Chioma is very much known around credit modeling. Now the expert in her own field, going to use more so that you know how important this edition of the members monthly credit management webinar is. Is anyone struggling to connect in there? Okay. Dr. Chioma Nwafo leads the quantitative. All right. Thank you very, very much. Okay, so Dr. Chioma Nwafo leads the quantitative research team at CEDAF Limited in Scotland. Yeah. She didn't stop there. The more profound one is that she is a lecturer in banking and quantitative risk modeling. Yeah. Not only that, the big one is that Dr. Sherman is the lecturer in banking and quantitative risk modeling at Glasgow Caledonian University in Scotland, United Kingdom. In these roles of which she performed on a daily basis, if you like, at CEDAF and Caledonian University, Scotland, Glasgow Caledonian University in Scotland. Within these roles, she develops novel risk and forecasting solutions for organizations, financial institutions, credit providing institutions, manufacturing, and so on and so forth, while at the same time providing thought leadership on related trends in developed and emerging economies, financial markets. Dr. Sharma Nwafo is the author of the book Data Analytics for Financial Risk Modeling and Forecasting. That book is currently in print, and hopefully it will be out for public consumption very quickly, as well as the author of some peer review articles in academic journals. I've had the opportunity to look through some of those articles she wrote, and she has presented her research in both local and international conferences. She is the founder and executive director of the Diaspora African Women Network in Glasgow, and an adjunct lecturer at the London Postgraduate Credit Management College, LPC, as well as the Postgraduate School for Credit and Financial Management here in Nigeria, which is a sister entity, subsidiary entity of our great institute. Dr. Sharma has experiences in managing and executing research and consultancy projects in the United Kingdom and Africa. She holds a BSc degree in accountancy from the University of Nigeria, Nsukka, as well as postgraduate and doctorate degrees in financial economics from the Adam Smith Business School, University of Glasgow. Dr. Sharma is a fellow of the Higher Education Academy in the UK, and is a fellow also of the Institute of Credit Administration Nigeria, as well as a licensed international financial analyst of the United States. So she's a very interesting person, very intimidating profile, a sticker to what she knows how to do best. She's not just hanging herself up in Glasgow. She's shuttled between the United Kingdom and Nigeria. She's very familiar to the Nigerian financial market and very much in touch with the current reality in the Nigerian credit industry. So that is the speaker we have today, and she's going to have as much as 45 minutes to an hour to present her opinion of what she perceived to be, the new thinking orchestrated by the COVID-19, how managing credit, corporate credit, is going to be an issue going forward. And so I can also see another English person just joining, and that is Kingsley, I guess. You're welcome to the forum. I wouldn't want to take much of the time because Dr. Sharma has a lot to share with us, and you are free to ask questions. You are going to be able to rationalize her presentation to the efficacies of the local market. And if you like, you can think beyond the local market, because the impact of globalization on each country's local market cannot be overemphasized. So we'll probably look at the linkages actually. And then you ask questions, you also make contributions so that, you will have also something to take away from sitting atop of presenting a very important, subject matter to a wider audience in Nigeria. You feel free to ask your questions, feel free to share your experiences and make a contribution as well. Learning never ends. We'll continue to learn, draw synergies and the strength from counterparts anywhere we can find them around the world. So once again, I'd like to welcome everyone to the Institute of Credit Administration's monthly Members Credit Management Webinar Report. Dr. Sharma, good to see you again. And I'd like to hand over to you now, the room for your voice to start vibrating. And people are coming in. We are going to be more than this number. I know some people like to join a bit late, but we're not going to wait for them. Thank you very much, and you are welcome.
Okay, thank you, Professor Chris Onalo, and thank you for the kind introduction. It's while you were going through the brief profile, I felt is that me? He was talking about, but the truth is we have been in the field of credit management. I have been in the field of credit management for some time now, and we have also presented in different papers on credit and credit modeling. I'm happy and excited to see everyone today, and thank you for giving me the opportunity to present my thoughts today with regards to how we rethink credit risk management going forward, what they like to call the next normal in the West. I'm sure that the COVID-19 pandemic is not battering Nigeria the way it's battering people here in the UK and maybe in the US. So we are grateful to God for that it's not hitting Africa so hard. But it's a massive thing here. In fact, as I speak with you today, we are already on a second lockdown here in Glasgow, some parts of Scotland. So it is still massively ongoing. And what I will be sharing with you today is what I call my thoughts on some of these things. And I would also ask us, like Prof said, to have questions. We can bring some of my experiences or thoughts to relate to what you are currently witnessing in Nigeria. I would like to share my presentation slide. It's not too much, I think about 10 or 15. But the most important thing is for us to engage. It's a two-way interaction, right? It's a two-way interaction, because I believe that a mind that is open to new ideas will never go back the same, its original size. So whenever I have this type of opportunity, I like to open my mind to learn from others, because learning and presentation, particularly to an informed audience like yourselves, it's a two-way thing. It's a two-way traffic. I like to say it's bidirectional. So as I'm presenting, I'm also going to learn from fellow members of the Institute. So having said that, I'm going to share my screen, and let's start the presentation. You can also use the chat, because I would monitor the chat area to see if I have questions. All right, thank you. I'm sharing my screen. I'll bring this here. Okay. Let's turn off my camera so that I don't, what was it called? I'll stop sharing my videos so that we can concentrate and get down to why we are here today and what we are here for. So for me, like I said, my topic this morning is actually on rethinking credit risk management post-COVID-19 pandemic. So it's also very, it's a very hot topic at the moment. And that's why I would like to share my thoughts on this very important, timely topic. So like we know, the coronavirus outbreak has generated a lot of unprecedented health risk crisis, and it's affecting people and countries all over the world. If you're looking at the map of the world, I can't really pinpoint any part of the world that is not being currently affected by COVID, by the coronavirus, but again, to varying degrees. So in the UK, in Canada, in the United States, and indeed in some parts of Africa, right? Even some parts of North America, you see massive number of deaths, infection rates, and all that. So it's real. And the pandemic is causing consequences that are far beyond the spread of the disease itself. So what we are witnessing and experiencing is not just the disease and the death. The consequences is actually far beyond that. Now, we know that when this virus started in 2019, that's why they called it COVID-19. When it started in 2019, so many countries in the West, and again from China where it started from, they took a number of measures to reduce the infection rate. Part of those was the closure of businesses due to the COVID-19, the shelter at home orders. People were ordered to stay at home. We stayed completely locked down in the UK for almost 3 months. And then we have this new normal that we are experiencing in the West called social distancing. And social distancing is simply people avoiding each other because we don't want to catch the virus. And then we are wearing face masks. It's mandatory in so many places currently in the UK, particularly in Scotland here, in Glasgow. Now, all these orders, the closure of business, the shelter at home, the social distancing, they are creating uncertainty for lenders. And lenders are wondering the ability of borrowers to meet current and future loan obligations. Of course, we know that with this closure of businesses and shelter at home orders and social distancing, a lot of companies, businesses are losing money, right? And we know that the economy is interlinked. So when one sector of the economy is not doing well, the impact can easily be seen and felt in other sectors of the economy. We will see the adverse effects of COVID so far, not just in the UK, but I believe around the world. We are seeing a collapse in economic activity as a result of COVID-19 containment measures. And macroeconomic instability has increased. The unemployment rates in most sub-Saharan African countries is out of the roof. Not just sub-Saharan African countries, also in the West. It's basically out of the roof. Companies require dynamic and flexible risk management to navigate this sort of unpredictable future. Because the implication of COVID-19 is expected to significantly increase default rates and credit losses, leading to large increase in provisioning requirements for banks and lenders. Not just for banks, any credit granting organization is at risk as we speak because of the implications of COVID-19. So financial institutions, credit lending organizations are expecting a significant increase in the rate of default. So in the next couple of years, we will be witnessing or experiencing high levels of toxic loans across different credit granting industries. Now, banks in particular, they face the prospects of massive drawdown of committed credit lines because businesses are struggling. So those businesses that they have granted or advanced credit lines will be making efforts to draw them down. And also facilities, particularly from firms in vulnerable sectors directly affected by the lockdowns. So for the first time ever, Emirates Airline this year posted a loss, a net loss after in their financial year for the first time ever. And not just Emirates Airline, a lot of companies here in the UK have become casualties because of this COVID-19. We have seen so many companies that are filing for bankruptcy and taking different government relief measures. Therefore, credit lending organizations and financial institutions must develop forward-looking provisioning models to allow for different simulated economic scenarios. Because except you have forward-looking provisioning models, when I say provisioning, I mean loan loss provisioning or expected credit loss models. These are very important because if you were told, let's say in March or January of 2019, that there would be a almost complete halt in global activities, not just in one region, that there will be a complete halt of global activities in December and January of 2020, I'm sure you will just laugh it off. You will see it as one of those doomsday prophecy, right? But that's what we have witnessed. So most of the provisioning models that financial institutions and lenders currently use, they are backward looking. So they use historical data to predict the future. But what we have seen is that the future can be very uncertain and things can change dramatically and very rapidly. No model would have been able to capture the level of halt in economic activities that we experienced starting from 2019 December up, and we are still experiencing them till now in most parts of the world. So these institutions that are engaged in any form of credit must then have to think of how to incorporate forward-looking macroeconomic variables in their current models. These simulations should include downturn economic scenarios, which are designed to stress test the bank's provisions and capital levels. Now, I'm taking a lot of things here for granted because this is members of the Institute of Credit. So I'm taking it that some of the terms, you already know them. Now, most times when we develop credit risk models for lenders, we take into consideration different economic scenarios. So we look at a situation where the GDP of a particular country, let's say Nigeria, right, where the GDP of the country drops to the negative region, right? So what happens to a bank's loan portfolio in that kind of situation, and how would that affect their level of equity capital? So we are advocating going forward that institutions, not just financial institutions, credit lending organizations, should now start to think of how to incorporate their scenarios into their models, because with what we have seen, nothing is impossible. Nothing is impossible. Now, although the sophistication of risk management differs across industries and companies, we believe that all organizations right now need to rethink and strengthen their approach to risk management to better prepare for the next normal. We were having some form of informal debates in the office here in Scotland, and we were asking if things will ever get back to normalcy. A lot of people think that they may not eventually get back to normalcy. Some think that maybe in the next couple of years, we will get back to normal, right? But for me, whether we get back to normal or we are experiencing the next normal or the new normal, what matters now for credit risk officers or managers, people like you and myself, is our ability to develop different. So I think that the next normal would require people like us that have developed different levels of capacity in modeling different scenarios and then thinking outside the box, because really the area of credit management and administration has a lot to do with thinking outside the box. It's not mostly quantitative in nature. The qualitative aspect will come very handy in the next coming months and years ahead. So it's important that we begin to align and realign our skill sets and our thought processes to how we can navigate the challenges that we are going to face in the next coming years. Whether we get back to normalcy or we have a new normal, it doesn't matter. What matters presently is our ability to do what? To incorporate some of the, what they call black swan, like some of the scenarios that you would never dream of, right? Now, nothing is impossible. You just incorporate everything. Now, today's presentation, we want to describe the essential elements of dynamic credit risk management, and then outline actions that lending institutions can take to build a robust credit risk management system that can withstand adverse shock to some reasonable extent. Now let's see the COVID-19 and economic activities. Some adverse effects of the COVID-19 pandemic includes the increased loss of income and revenues. Small and large businesses are currently facing significant reductions in their revenues as a result of different measures that the government of nations are taking in order to curb the spread of this virus. We have seen also significant plunge in economic activities. The COVID-19 pandemic has put strain on the economic activities of most countries, not just in the West. It's also the same in Africa, in Nigeria, in different places, because the world is now a global village and it's interconnected in more ways than we know, right? Now, other adverse effects of COVID-19 pandemic, it's also the increased risk of default, which is what concerns us as credit managers, right? Many lenders are facing breach of a loan contracts by their borrowers, because if the unemployment rate is increasing as a result of the negative shock coming from the COVID-19 pandemic, people are losing their jobs. In most cases, individuals and customers would pay back their credit from their income. And if they don't have any source of income, you see the effect of that loss of income will be seen in banks or lenders' balance sheets, right? Then we have seen lots of pressure on companies' cash flows. It's related to the increased loss of income and revenue. Slowdown in economic activities is currently putting a lot of pressure on business cash flows and working capital. So businesses are needing support from the government. Here in the UK, the government has given massive support to businesses, different levels and categories of businesses, just to help them survive the effects of the pandemic, and also to stimulate the economy so that we don't go into deep depression. But I don't think, from my personal opinion, I don't think that these massive support would prevent the impending global economic crisis that we would witness. I don't think it will, except they do the economic reset when they go to Davos, then we would know how 2020 and 2021 and 22 and going forward, how things will pan out. So these are some of the adverse effects of the COVID-19 pandemic. This is aside from the death, the massive number of deaths that we have witnessed around the world. Modeling forward-looking expected credit loss. It's very important for lending and credit granting organizations. Now, there's what we call the IFRS 9, International Financial Reporting Standards 9, which requires most financial institutions to determine forward-looking expected credit loss or losses. This came into force after the 2007 financial crisis. Now, financial institutions and other lenders in different sectors are now have this obligation to incorporate some forward-looking factors or scenarios as they model their expected credit losses. Due to the effects of the pandemic, lenders are expecting an increase in loan provisions, which would have a significant impact on their capital and reserve. At present, I think major banks in Nigeria seem to be having enough capital cushion, because we haven't had any negative news coming out from that place. At present, they seem to have enough capital buffer, but the uncertainty in how long the pandemic will last is a cause of concern, and it should be a legitimate cause of concern to most of these financial institutions and lenders. Because if this COVID thing lingers, if it lingers on, right, what it means is that we will continue to experience this sort of disruptions in economic activities. A second lockdown phase in the UK will spell doom for a lot of businesses. Yesterday, 2 days ago, on Tuesday, Glasgow announced they moved their COVID-19 risk level to tier 4, which requires non-essential businesses to close again for the second time in a year. So imagine what happens to the employees of such businesses. They have got bills to pay. They have taken out mortgage loans, car finance. They have taken on, some of them, even when they haven't taken mortgages, they have rent to pay. And without job, and going into a 3 weeks, which we know will very quickly turn into a 1 month or more, right? Very quickly, from using the benefit of hindsight. So banks and lenders would have to brace themselves, start making arrangements on how to manage the high level of toxic loans that they will experience after the COVID-19 pandemic. Key areas to focus first will be modeling economic scenarios. This is a very difficult task, very difficult. It is difficult to obtain reliable and detailed macroeconomic forecast in order to calculate forward-looking expected credit losses under this climate. Things are changing very quickly. IMF they've had to reverse the GDP forecast growth for so many economies. So they've reversed a lot of times, right? So this is a challenge for most lending organizations. For example, for a retail banking loan portfolio, many banks, especially in Nigeria, would expect some macroeconomic variables like household debt, income, unemployment rates, and interest rates to drive some of the risk factors. So the idea would be to find, I'm just showing you the figure here is the probability distribution of key losses that we modeled, right? So the challenge here is for credit or lending institutions, including financial institutions in Nigeria, and then you people as credit professionals to upskill. Skilling is very vital in order to survive this present condition that we are witnessing. Because now your skills, they are in high demand. They are in high demands. The challenge for most organizations, for most financial institutions and lenders is how to integrate these key risk drivers, household debt, income, unemployment rates, how to integrate them, because we are no longer using static or deterministic models. We are now using probability distributions to represent some of these key factors, right? And then begin to then see their effect on the capital and reserve of different lending organizations. So this is how it works. You define the probability distributions for household debt, income, unemployment rates, and interest rates, right? And then model them, then use scenario analysis to check the effects of these key variables on the capital and reserve of the company or the bank that you are working for. So bank management teams will have to closely monitor these variables: the growth in household debt, the drop in income, the increase in unemployment rates. They have to monitor them closely and then apply post-model adjustments to capture the current challenging conditions. So it is no longer acceptable for banks to have static models. It is no longer acceptable. You need dynamic models now, models that can incorporate these things in real time if it's possible. If it's not possible, at least every 2 to 3 months, you reverse your model, you refresh it to capture the current realities. Key areas to focus would be on the credit score. So I've developed key areas that corporate lenders and financial institutions should focus. Credit score. So they need to remove borrowers that are under different moratoriums and different government interventions. They need to account for those measures when they come up with their credit score. They need to also recalibrate their income levels due to COVID. You know, when you make loan applications to financial institutions or to credit institution, they will, based on the historical characteristics of the individual, they will come up with a score. And this score they assign to individuals is a score that will determine their probability of default, the probability that they will default in their loan. Now, if this score is high, the bank would then have to implement different measures. When they compute this score, if it's high, they implement different measures or they apply different measures to that particular applicant. So let's say the probability of default for applicant A, according to observed financial and demographic characteristics of that particular customer, is 90 or 80%. It's quite high. Banks may not refuse you, or lenders may not outrightly refuse giving you credit. What they could do would be to increase the interest rates, for instance. So they can increase the interest rates. They could reduce the amount that you are requesting for. So they could use credit rationing, and different risk-based pricing would apply to your application. Now, in assigning these credit scores, it's now very important that financial institutions and lenders, not just banks, because you have different organizations that lend, maybe they do credit sales. And in the UK, that is massive. You see a lot of stores, big stores that do credit sales. So they are part of what they will be considering. In revising their credit scores that they have assigned to their customers, they need to take into consideration the different intervention measures that government has given as a result of the effect of COVID-19. And one of them is to consider those clients or borrowers under different moratoriums and under different government interventions. The next one is the financial ratios. So lenders would need to review their borrowers' financial ratios. Instead of leaving that for 1 year annually, which is normally the case, they may want to do that monthly, pay attention to those ratios, right? So that they know how to manage their customers. In fact, what most lenders are doing now is they're actually trying to monitor customers that are at risk of default. They monitor them closely. And they do this vis-a-vis their capital level. So they are looking at, okay, if for whatever reason, we have over 1 million, for instance, £1 million in toxic debt as toxic loans, they are looking at their capital and reserves. Will our equity, capital, and reserve be able to carry this level of debt, toxic loans, if it materializes? So what is the probability that it will materialize? So this time around, we don't use static models. We use probability models incorporating forward-looking severe scenarios, and then testing that, stress testing your capital or your reserve. Very important. Days past due, we know that banks will classify, depending on your financial jurisdiction, they will classify loans under non-performing and all those doubtful loans, loans to watch, and different other categories. So it's important that they make a distinction between those customers that have actually defaulted and those that missed payments due to government interventions. These are two different clients now in the loan portfolios of different institutions. Some borrowers or customers may have missed payments because government has asked the banks to, okay, be lenient to customers in the sectors that are particularly hit most by the effects of the pandemic. And some of these sectors are aviation, for instance. When you have complete lockdown, when we did complete lockdown in the UK for almost, I think, 3 months or 4 months, flights were not, both local and international flights were grounded. So what happens to the employers, people that are employed within that sector? British Airways and Flybe, different local and international domestic flights in the UK were severely impacted and affected as a result of that. So because of this, government has also come up with massive levels of interventions. And part of them was requiring bank and mandating them to apply some leniency. Lenders on their own part will also strike a balance between supporting the economy and then looking at their own capital and reserve, because they are also vulnerable to the effects of this pandemic. And keep in mind that this money that government is giving out in order to support the economy to weather the storms of the effects of COVID, they are not free money. At some point, government will need to, because their balance sheet has gone so big. So at some point, they will need to balance that balance sheet. So we are anticipating increase in taxes, in tax rates in the UK. And even in Nigeria, if government has given any sort of palliative, because they have to balance those deficits. And in balancing them, there may be potentials to increase the tax rates, VAT, employee tax, and all different categories of taxes. So that is what we call forward-looking. So you anticipate and try to preempt an event before they happen. And then when you anticipate, you try to model, quantify that event, and then make preparation, decide on how do you want to go, how do you want to manage this in the event that it becomes a reality. On the qualitative side, so these areas, the credit score, financial ratios, days past due, they are on the quantitative side of your model, right? You need to think of these, when you recalibrate, you need to look at the income levels of your customers. This is where you monitor what is happening, because a customer that was maybe previously at the beginning of the loan contract, a customer that was assigned an A rating may very quickly degenerate or migrate to a C rating or a C level. So what I'm saying in effect is that these things are dynamic. They keep changing as the effect of COVID becomes more clearer. Then we look at troubled debt restructuring. Also, banks are restructuring a lot of troubled debts. There are actual troubled debts that were not as a result of COVID. So these were debts that had issues. They need to separate the two in their portfolio. Then there are also troubled debts due to government interventions, right? So these people ordinarily were paying until the arrival of this virus. So they have benefited from maybe a payment holiday or a moratorium or whatever intervention that government has advanced. So they need to monitor those as well within their loan portfolio. Then the watch list, lenders, financial institutions, and credit advancing companies or firms will need to monitor very closely clients that may be working in the sectors that are heavily impacted by the COVID. Supply chain is another sector that was heavily impacted by the effects of COVID. Hospitality industry, aviation. These are industries that were heavily impacted as a result of this COVID-19 pandemic. So these are key areas to focus, both quantitative and qualitative areas that creditors, I say creditors, that lenders and financial institutions should pay attention to. Then we have the different, just by way of summary, summarizing the previous slide, we have the different areas that lenders should pay attention to. So in the application scoring models, closely monitor the effect of COVID-19, the effect that COVID-19 is having on businesses and individuals. recalibrate the scoring model based on updated valuation and financial ratios of borrowers. So this has to be done if it hasn't been done already. And the challenge for credit officers and credit modelers is how to do some of these things, right? So that's why I always emphasize upscaling is very important in this period. Then the behavioral and repayment models has to be monitored. Models to account for repayment holidays, moratorium, forbearances on loans extended to borrowers. In the behavioral scoring models, lenders should take these things into consideration so that they don't migrate a customer that would ordinarily be meeting their payment obligations, if not for the different interventions. Maybe they were given a repayment holiday and the model is classifying them as default, because all these things will have implications on the capital and reserve of the bank or the company. So these sort of individuals would have to be separated. There has to be a clear distinction between these two customers. Stress testing and scenario analysis. Credit risk models should include severe and dramatic economic scenarios. Before the COVID-19 pandemic, when we model credits, we model credit or forecast credit defaults. There are some scenarios that you would incorporate. People will question them. How can you think of such a scenario? It can happen. It hasn't happened. And some people will say that this is a 1 in 1,000 year event, 1,000 years event. So there's no point including such scenarios. But what we have seen with the COVID-19 pandemic and its economic consequences is that nothing is off the hook. Nothing entirely is off the hook. You see a company that is doing very well today, tomorrow it can quickly change. Banks should get some insights from the CCAR models in the West. That's the credit stress testing models that they use here in the West. Then another challenge is the IFRS 9 forward-looking scenarios. Now, credit models to review existing macroeconomic variables that drive credit risk defaults. Some of these macroeconomic variables, we mentioned them before. Unemployment, interest rates, GDP, we incorporate them when we model these forward-looking scenarios, because structural breaks in economic variables should also be tested when building forecasting models. These are very important things that we should be paying attention to. Some of the important skill sets for credit risk officers. These skill sets are very important in the current economic condition or climate that we are currently living in. One is the ability to anticipate, predict, and model risk based on both internal and external data. If you haven't acquired this sort of skill sets, I would encourage you to upscale, because now organizations, both big and large, are looking for people with this sort of skill sets. It's not just financial institutions, because every organization would, no matter the sector, they are facing the same type of risk that everyone is facing: uncertainty. Everyone, whether it's aviation, food and beverage, information technology, financial services, whatever sector, they are all facing the same uncertainties with regards to their businesses. So they are having to make decisions. And these decisions, they are quickly realizing that these decisions should be data-based, evidence-based decisions. So the ability to model and predict, maybe using historical data or theoretical data, as the case may be, it's a very important skill set for all credit risk officers to have. I say to my students most times, it is not risk, except we have quantified it. Quantification, putting a value, a number to the event. It's of no use to a bank manager or a chief executive of a corporation if I walk into their office and I say to them, oh, COVID-19 is hitting everywhere and the economic effect is massive. And these are some of the risks that our company faces, right? Then I start to tell them that there could be a drop in our sales, there could be a drop in our sales revenues, or the volume, our sales volume, or there could be a drop in the GDP of the economy, and this is how it will impact on our company. I mean, the guy, if they are being economical with the truth, will just say thank you to you, but that's not what they are looking for. A CEO wants to know, okay, if this happens, how much are we going to lose? Because that's the starting point for every risk analysis. And it's particularly important in this post-COVID. So they are asking you, all right, if this sort of event that you're describing, if it happens, or if COVID continues far into the future, how much are we going to lose? And how likely are we going to, is it that we will incur this loss? That's what they are looking for, right? That's what they are looking for. So you give them a value. You could say, okay, we have done our probability distribution of losses or our net revenue, that if COVID-19 continues far into 2022, we are going to, or far into 2021, let's say, because now we encourage short-term modeling or forecasting. Let it be very short-term because the situation is very fluid and dynamic. So you give them a value. If the pandemic continues till 2021, we are likely to lose 10 million in revenue. Okay, 10 million naira in revenue, that's fine. Then the next thing they would do would be to look at their capital and reserve. Imagine that your firm is like Apple that has stashed up enough cash, liquid assets. So they're likely to lose 10 million. The next question will be, so what is the probability that we will lose this value? And then you say it's maybe 10% or 20%, right? Or you say it's 90% or 99%, but there's also a 1% chance that we may lose something more than this 10 million. So if there's a possibility of incurring this sort of loss, the manager would then, the next question would be, then how do we prevent it? How do we position ourselves to be able to weather this sort of loss in case it materializes? Your answer will then come from the stress testing or analysis of the company's reserves and capital. So you're looking at, oh, this is a robust company in terms of capital. So assuming the company is like Apple, like I said, they have stashed over 100 million in capital. A 10 million loss, even if a 30 or 20 million loss wouldn't wipe out their reserve and capital. In fact, 3 years of sustained losses of that magnitude will still not clear out their capital base. So that's why the ability to anticipate and predict and then model risk is very important for credit risk officers. Then the next skill is the ability to set risk limits and assess risk magnitude, as well as control weaknesses. So when we have modeled, we have assessed risk, we have determined the possibilities of this happening and that's not happening, the next phase would be to put adequate controls in place and then to test these controls for possible weaknesses, right? So the control in the scenario I've just painted could be they will fall back on their reserve. So what happens if this company hasn't saved this amount of capital and reserve? What will they do? So it's your job as credit risk officers to think outside the box and then make recommendations. One of such recommendations could be, okay, you might be telling the boss, okay, boss, can we raise additional equity capital, or can we raise capital? Can we raise capital in case this sort of thing materializes? So they are now sitting down to look at the different sources of capital that they can quickly call upon if this happens. Now, again, the next decision would be, what sort of capital do we raise? Is it debt? Is it equity? If it's debt capital, what sort of instruments are we going to use? And at what price are we going to price the debt? What interest rate? If it's equity, are we issuing new shares? In that case, we are doing a seasoned offering, or are we doing another rights issue? Because our shareholders may not want to dilute the ownership. So these are some of the things that credit risk officers would start thinking about. And the most important, like I've said, is to acquire some of these skill sets. Ability to decide swiftly if risk requires immediate or prolonged response, and determine appropriate response. These are very important skill sets for credit risk officers to have in this current climate, and then going forward, because our next normal, the next normal will not be the same. It will not be the same in fact, across all sectors. Higher education in the UK, most of us that had phobia those days doing online teaching, we have seen that, I mean, this could be the way to go. It could be that in the next 10, 15 years, just the way we are seeing rapid closure of bank branches in the UK, we might be seeing that the brick and mortar classroom model may not be visible anymore. It may not be viable anymore. Universities are starting to understand that instead of incurring loads of overhead expenses on these massive buildings, things can be delivered online fairly quickly. In fact, the two models I teach in the university at the master's level, financial risk modeling, quantitative risk modeling, and bank operational risk. These two models would require us to use the finance lab where we have computers and softwares installed. Now, the university has developed what they call remote labs. So students can then log into the physical lab, but remotely, and have access to the same computers and the same softwares. So it's becoming increasingly important, and is becoming also increasingly apparent that what we have before, the conventional learning and delivery model, may not be what we will be using in the next normal. So these are the different key areas that things may change. Now, because companies would have lose a lot of money, they would have incurred a lot of loss, they would have incurred a lot of toxic loans if it's financial institutions, they will be looking at how to downsize. In the process of downsizing, they are looking at skill sets. So who is relevant and who is not? Upscaling and this type of webinar is very important for the members to attend. Important considerations for dynamic credit risk management. So we are advocating dynamic credit risk management, no longer static, no longer the situation where we develop the models and then we revisit them after 1 year, at times after 2 years. And it wasn't a wrong model anyway, while it lasted, because at that time, we revised models based on the sector. If a particular company is trading in a sector that is very volatile, right? You want to revise the model every 6 months or 6 to 1 year, 6 to 12 months. If a company is trading in a sector that is not as volatile as the other sectors, you may want to revise every 2 to 3 years. But now volatility is what we are experiencing in every sector. Today is tier 1 level, tomorrow is tier 2, the next day they drop it to tier 1. So where are we heading to? So there are important considerations that you as credit officers would need to consider in order to develop your dynamic credit risk management. One of such is how will risk evolve over time? Risk can either be cyclical or mean reverting or structural and permanent. The usual risk models that we use before this pandemic, we normally base them on cyclicality. And that is why we say that credit risk is cyclical. So in periods of economic booms, you see very low defaults, right? So in periods of, we say that credit risk or loan default rates follows the business cycle. Now it's also that notion is starting to be challenged. People are beginning to question that notion of pro-cyclicality or even counter-cyclicality. So we are looking at risk can evolve very quickly, right? The next consideration would be, are we prepared to respond to systemic risk? So you're just risk assessing your organization. How prepared are you to respond to systemic risk? Lending institutions must consider whether the event triggering the risk has wider implications for their industry or the economy at large, and what that means to them. COVID-19, a typical example. The implication of COVID-19 is not sector-based, it's a systemic risk. The next question will be, what new risks lie in the future? So what are the new risks that we are likely to encounter in the future? Forward thinking. The next new normal requires credit officers that are forward thinkers, not just static thinkers, not officers or credit risk modelers that use deterministic models. Companies will need to cast nets wide enough to detect new and emerging risks before they happen. And like one example I gave to you is the likely or possible increase in tax rates, right? Likely or possible increase in tax rates in the UK. Because at the end of the day, the government will need to balance their books. And in order to balance their books, there's a huge possibility that they may be increasing the tax rates. Then how much risk should we take? This is the final consideration. Rapid changes can quickly distort companies' risk profiles. So companies will need to adjust their risk appetite to accommodate shifting customer behaviors and global trends, right? And when you look at your risk appetite, you're looking at this appetite vis-a-vis your reserve, your level of reserve and capital. If it's a bank, the most important element of capital would be the equity, because that is the debt, the loss absorbing capital in a bank's capital structure. It's actually the equity capital, right? So they are looking at, if we experience a sustained severe event that can result to a loss of X amount of Naira, how will our reserves and capital buffer such a loss? And if this loss continues, right, for the next 2-3 years, how do we respond? These are critical, important questions that risk managers should be asking in the next new normal. What are the actions that we are recommending people take? First, incorporate forward-looking scenario-based simulations in your credit risk framework. Very important. Scenarios, you define different scenarios, and not just defining them, and also looking at the effects of these scenarios on your output. Your output could be the company's net revenue or net profit. It could be the company's capital and reserves, right? It could be the company's net present value. It could be anything. So the company defines their output, and then they incorporate severe adverse scenarios into the risk drivers that drive that output, right? So these are the important actions that companies should take, and credit risk officers. Because when I say companies, it's actually the credit risk managers or the credit risk modelers that will take such steps and then advise the management. Harness the power of data and analytics. This is very important. This is very important. We are starting to see from a desk research that we carried out in the department that in Africa, Asia, and some parts of the Western world, particularly UK, the demand for finance professionals with technological acumen far outweighs the supply for that skill set. It far outweighs it. Companies are looking for knowledgeable finance professionals, but not just finance professionals, but with at least a healthy level of data analytics knowledge. It's not just within the financial services sector, it's across board. Health sector. Bioinformatics is now the new future of medicine, right? In pharmaceutical industry, they have been using data for so long. So individuals, because this action is actually tailored to individuals, credit risk officers like yourself and myself, right? You need to upskill. This upskilling is not, you shouldn't take it lightly. And that is why this sort of webinars are important, and different types of trainings. Harness the power of data and analytics, deploy algorithms for better fraud detections and predictions. People are increasingly now relying on machine learning, artificial intelligence, big data analytics in order to inform their decisions, both at corporate and individual levels or departmental levels. Develop risk talents, good risk talents with a good understanding of risk landscape. So the Institute of Credit Administration, I think, should be at the forefront of championing some of these things. Finally, fortify risk culture. So companies should fortify their risk culture and embed it across the business activities, right? So that from top to bottom, they all understand the risk culture of the company, their risk appetite, the level of risk they are willing to take, their risk threshold, how they treat risk. Some companies will treat risk or see risk as something to avoid entirely. Some will see risk as something, okay, to take, because they hire the risk, they hire the returns. So most companies would want to take informed risk. Informed risk. So these are the core areas that your organization or your organizations or at an individual level should pay attention to. It's important to harness the power of data. It's important to upskill, and it's also important for organizations to look for credible risk modelers who can combine both quantitative and qualitative aspects of risk in order to drive their decisions going into the new normal. Thank you very much for listening. I would open the floor for questions and discussions, if you like, not just questions. You can also discuss, you can also contribute to the presentation. Like I said, it's not a one-way presentation. The idea is for us to share knowledge, to share experiences, because the way that COVID is affecting us here, the way that COVID is affecting us in the West could be a bit different to how it's affecting you people in Nigeria, but the fundamentals are the same. Risk is risk, right? So whether it's affecting you, okay, let's separate COVID into two things, the effect. You have the health effect and you have the economic effect. So the health effect in Nigeria might not be as severe as what we have in Scotland or in the UK. But the economic effect, I believe, is the same across board. So let's open the floor, hear your thoughts, and take your questions. Thank you for giving me the time and the opportunity to present today. I hand over to, is it Prof or the moderator?
Yes, Prof. Thank you very much, Dr. Sharma. This is excellent. This is
Thank you.
Instructive. This is inspiring. This is upscaling. You know, this is a new wave. You've said so much. You've brought out so much. Nigeria is happy right now, getting some of these things downloaded to our landscape so that we can make very quick and relevant adjustments with a view to standing tall in managing and confronting our risk scenarios. Thank you so much.
Thank you.
Thank you so much. And that is Dr. Sharma, one of the lecturers at the Glasgow Caledonian University in Scotland, UK. He's also adjunct lecturer at the London Postgraduate Credit Management College in the UK, and also Postgraduate School of Credit and Financial Management, PSFM Nigeria here. From time to time, we will be bringing Dr. Sharma to take on these courses at the local level here, Postgraduate School of Credit and Financial Management, which is a subsidiary entity of the Institute of Credit Administration. We are doing all of that, as you can see, to strengthen the professionalism of people in credit management and to make Nigeria a flying country, you know, within the African continent. So once again, thank you so much for this very important delivery. There's so much to take home. Yeah, so much to take home. You've talked about no more static, the use of static credit risk management model. There's no more deterministic credit risk management model. And what is what is in now is a new invention, a new conscription actually, a dynamic credit risk management model. And then you talked about creative thinking, you know, as in quality of today's credit risk officers, and so on and so forth. You said so many things along that line. You also highlighted the challenge, the obvious challenge post-COVID-19, the ability of borrowers to meet current and their future obligations post-COVID, and that is quite critical. You know, it's no longer the old market. The COVID regime has brought in a new market. and people should recognize that and think quickly on how to restructure, identify the implications of the new market and structure in such a way that you can, catch up with the trend that is being generated. And then you talked about organizations. Are you there?
Yeah, I am.
Is everyone there?
We can hear you, sir.
Yes,
right.
we can hear you.
We can hear you.
You also gave to us now organizations need to rethink and strengthen their approach to risk management. It's not going to be the old normal anymore. Thinking outside the box in credit management risk and the administration is what is required going forward. Expecting more increase, of credit default. That is obvious. So many things one could think out of this paper, and then because of the practicality nature of this, I am feeling very strongly that Dr. Sharma is going to have a Herculean time to provide answers to certain questions, or some people navigating through the local knowledge about what credit market is saying to businesses in this country. Let me also inform Dr. Sharma that we have a lot of media, journalists in the room, and I'm sure they would like to take on some questions with you as well. So having said that, once again, thank you very much, the eminent Dr. Sharma, for doing great justice to this very incisive and globally accepted profession called credit risk management. So I want to invite the members of the Institute in the room to begin to fire your questions. And if there is any area you are not too clear about, ask for further clarification. Dr. Sharma is still in the room to attend to any questions. Thank you very much.
Thank you, Prof.
Okay, I just have a request. This is Emma Ajayi.
Yes, Emma Ajayi, go on.
First of all, I'd like to thank Dr. Choma. That was very good, very technical, very illuminating. I would like to request that we have copies of this PowerPoint presentation.
Okay.
So that we can go through them again.
Okay,
I
it's
hope
not a
that
problem.
request will be granted.
Yeah, I'll send that to the Institute, to the secretary. Or I can send to Prof, and he will make the copies available to you.
Thank you very much. Thank you.
All right, thank you.
Question, please. Take your question, take the room, ask questions.
Okay, I would ask a question now. Good morning, everyone. And Dr. Choma, thank you so much for that presentation. Obviously,
thank you.
I can't say enough how good that was.
All
and
right.
I've always said that hold you in high esteem, and I appreciate it very much because, as you know, I work in the I'm very much into credit risk modeling and all of that as well. So very much appreciate the the insight into how we should be looked at, going forward post-COVID. To be honest, I have a million questions to ask, but I'm not going to ask all of that. I'm sure maybe one or two persons might also have. But obviously, COVID has been this has been an interesting year, and I know you did say sometimes these kind of events tend to happen, once in a lifetime, in 1,000 or 100 years. But I want to take us back 10 years ago or so. We had we had a global financial crisis, which was triggered by obviously something completely different. In this case, we have a health issue, far different to what it was 10 years ago. And in the aftermath of that, there was a lot of things put in place in terms of how financial and credit risk was managed going forward, especially within the banking and finance industry. But obviously that also had impact on the general, other industries as well, in terms of how credit risk is managed. And I cannot help but, kind of look back at all of that was put in place post 2008, 2009. And I'm just wanting to ask, do you see any, first of all, do you see what's been the impact of those kind of measures that were put in place after that? And how has it had any help, any impact in either tempering the impact of coronavirus, 10 years after, just 10 years after, after the last one? So do you see any similarities or any differences in how that was managed and how this is being managed and what the future holds?
Okay, yeah, it's a very interesting question. Like you say, the two scenarios are entirely different. In 2007/2008, what happened was the mortgage, the overlending, if you like, and the last monetary policy that the US implemented immediately after the 2001 terrorism attack in the country. So the system became awash with a lot of liquidity, and banks became a little bit careless in what they were doing. And again, with the political view of light touch regulation going on during that period. So that was a financial banking crisis. And the main difference between the financial banking crisis that we saw between 2007 to 2009, right? And what we are experiencing now is actually that now, during that time, we did not experience total lockdown of the economy. People were still doing their businesses. We all knew that there was a problem within the financial system. And this problem, just like finance is the engine room for the economy. So this problem quickly spilled into the real sector of the economy. This time around, things are completely on shutdown. Companies are not trading. Individuals are not even interacting. So there's limited social interaction going on right now. Now, part of what I would think that is helping, aside from massive government intervention in order to stem the effects of the COVID-19, part of what you see that has helped the financial institution to act as the lender of last resort to the public is because of the robust capital base that they were asked to acquire after that crisis. So they came up with stress testing immediately after the 2007-2009 crisis. And when they do these stress tests, they simulate very adverse conditions, but not anything near what we are experiencing. So it's made the banking industry or the financial industry, if you say ready, somewhat ready to take on the challenges of this virus. So that's one aspect that we see that is good. The lessons learned from the 07-09, right, were also implemented right now, because you remember the 1930s US depression. The lessons they learned from that depression was also used to solve the 07-09 crisis. And that lesson was, you need to throw, and I sad to say this, but you throw money at the problem, right? They came out with quantitative easing. So throwing money at the problem, because in 1930s, they did not do that. And it led to massive hunger and death. The same thing is what we are seeing now. Quantitative easing is also being implemented in different parts of the world. And by the way, quantitative easing is the process that government would just literally, let me not use the word print money, but allocate money to individuals via the banks and financial institutions. So the lessons that were learned from the global financial crisis, the quantitative easing, the low monetary policy rate. Right now, most Western economies, their policy rate is almost below zero, getting into the negative territory. And what does that tell you? It tells you that the financial institutions are getting money for free from the government, technically. That's what it means. So why are they getting these things? Is to support household, is to support businesses, so that we don't see ourselves battling with coronavirus, which is a health crisis, at the same time battling with a financial crisis. And that is the strategy that most governments are using. They don't want to have two massive crises. They don't want to deal with two massive crises concurrently. Does that answer your question?
Okay, I think that
yeah, absolutely does. Thank you. Yeah.
Good.
Okay, thank you very much. Next question from the room. The floor is yours. Please come up with questions. The presentation isn't technical. That's the nature of credit management, especially when you're looking at modeling. So you expect that, to come. Yes, the floor is open. Okay, the media in the house, does anyone have any question to ask the speaker? Don't wait for the slide, because if you don't ask questions, you are not likely to understand what the slides contain.
Yeah, but that's the future of credit management in Nigeria, and we should make it our future. But it's not. How do I put it? It's not. Credit management is both a technical and a qualitative area. It's a very interesting area with massive opportunities for people that are willing to upscale, right? And what I say to people across the world, where we need this sort of technicalities and talents is actually in Africa. So it's starting from today, I think the mission of the Institute will be to upskill the talents of everyone in this room, so that when this sort of presentation is made, we can have an intellectual discussion, right? When I say intellectual, I'm not trying to be critical, but what I mean is you could talk from the perspective of knowledge and ask the questions from the perspective of knowledge. I'm sure that if you leave Kingsley, he will ask all the questions, because that's what he do in the UK. You can't model credit. You can't be a successful credit risk officer without knowing how to model credit, or except you quantify risk. It's not risk. What are you managing without quantifying and assigning probability to the risk? What are you managing? Nothing. It's wishful thinking. It's another storytelling. But if we want to be good credit risk analysts or managers, we ought to upscale to the point where we learn some basic probability theory and then apply them to real world data sets in order to quantify and manage our risk. So if the presentation is too technical, I'm sorry for that, but going forward, I believe the Institute will organize this sort of webinars or meetings where we will have time to begin to build your knowledge around some of the themes that I have presented or I have spoke about.
Yeah, thank you very much, Dr. Sharma. I can see some questions are coming up there, and I like you to ask that question, orally. Just speak out. You can write your question and read it out. Mrs. Whistler is on now. Can you ask your question, please?
Okay. All right. Good afternoon, sir, Professor Nalo, and Dr. Choma and the other participants.
Thank you.
I'm highly impressed, seriously speaking, because I'm also an accountant, and I'm so happy that my colleague is doing wonderfully well in other field. I'm so challenged. I feel so challenged that I need to toe your line. So thank you so much. And it's a very eloquent delivery. I really appreciate it. I'm happy that I was able to join.
Thank you.
My question is, I've heard about data analytics several times, even before COVID. In view of the fact that a lot of us, like me especially, are busy people, how do you advise somebody to learn? Are there online learning opportunities? Because it's things that comes up all the time that you now realize, even before COVID, we realized that we need to increase our knowledge and upscale our skill on data analytics. So I really want your sincere and opinion on how to go about it. Thank you.
Okay, thank you, Whistler. It's a question that I normally get all the time, not just from Nigerians, but all over the world. You see, there's no way of making decision without analyzing your data. It might interest you to know that almost 99% of what you do currently or the decisions you take in your personal life, they are based on data. So when you are making a decision on whether to wear a particular outfit or not, right? You're looking at the historical event, or if you like, antecedent, previous event. So maybe you have worn this particular outfit and people are saying, oh, this suits you, this, and you have another occasion. You go back and say, okay, that outfit that people like, that's what I'm wearing. It's data. It's evidence-based, right? So data analytics is not as daunting or difficult as people think. There are different areas of data analytics, right? You have the database administrators, you have the data wranglers, you have the data analysts, the people that just analyze the data, right? Now, for people that are starting into becoming these data people, I would advise they start from the basis. There are a barrage of videos, plethora of videos and materials online that you can use. You can start from basic or simple Excel building, Excel analysis, analyzing data in Excel. I lead an organization called the Diaspora African Women Support Network, a foundation, Rosa Foundation in the UK, gave us some funding to train Black and Asian minority women in the area of data analysis. It's an entry-level training. So they paid for everyone, right? For 24 weeks, I think. Now it's going to end sometime in March. We do that every Saturday. We started from when they started, right? They expressed the same phobia for data, but we started with Excel, and we are in the about 6th week of the training. The dashboard assignment I gave to them, I said to them they are going to submit on Saturday. Almost half of the class have submitted. And I'm wondering, these were people that did not even know how to activate a cell in Excel. Coming into that training, we did what we call baseline questionnaire. We took their knowledge, because at the end of the day, when we report back to the funders, we want to say this was what they knew coming into the training. This is what they now know after 24 weeks, right? So you have a plethora of materials, both in YouTube, written articles, textbooks that you can use. But I will advise that you don't jump into the core analytics area, because it will scare you. What some of them were telling me was they don't want to write code. You see, technology or technological advancement has made our lives super easy, that we don't need to be programmers in order to apply data analytics at all. You see what I showed you, the probability distribution I showed you, I did that with a click of button. I didn't need to write anything. I use @risk. @risk is a software, or Crystal Ball. These are softwares that you use to model risk. Now, the challenge is the theoretical understanding. So if you have the theoretical understanding, you can do anything. because our area of data analysis is in the area of application. We cannot play the catch-up games with the programmers. No, that will just weigh you out. What you need to do is to start with basic Excel modeling. How do you activate Excel, a cell in Excel? How do you plot a graph? You have a historical data. How do you plot a graph? How do you do trend analysis, bar chart, and all those stuff? You start from there. From there, you start to build your skills. And then before you know it, you are doing real data analysis. And let me assure you that you can be a guru in this field without knowing how to write a single line of code. Exactly. It's possible because a lot of softwares have been designed with very good graphical user interface, GUI. So all you need to know, I went into writing code in Python because I needed to teach my PhD students something. If not, I've done data for how many years? I haven't written any code. If not that I needed to do that, I wouldn't have started doing Python. But once you start, writing code becomes super easy for you because then you have increased and expanded your knowledge and your mind. So the most important thing is to make a decision that this is what you want to do. That's the most important thing. And when we signed these women up for the training, we told them, we've got people in the waiting list. We only have funding for 15 women. We got application for over 30, double the number. So if you know for whatever reason that you will not stick with this training till the 24 weeks, please don't start. Because you will be distorting or using the chance of another person. So what I have seen most cases is that people will start out at the meeting of the smallest resistance, they will back off. Data analytics is the way to go, whether for accountants, for finance analysts, for bankers, for anybody, because you need to be able to make evidence-based decisions.
That's right. Thank you very much, Dr. Sharma. I have this question for you that's coming on the screen. And it's coming from Priska Undu. And now the question is this: as a credit manager, being faced with the current realities of COVID-19, how can you remain successful in your business when most of your borrowers have probably lost the ability to repay? How do you minimize the risk of default and reduce the number of non-performing loans?
Wow, this is it's a handful, to be honest, because the environment or the climate where you are, which is Nigeria, I read that CBN gave massive amount of interventions, right? They gave up to 139 million targeted credit facilities. They injected over 3.6 trillion naira. I've read lots of interventions that they gave because the problem is COVID-19, right, induced credit defaults. Because that's what we are seeing. COVID-19 induced credit defaults in the West. It's sort of taken care of. Why do I say that? Government came up with loads of interventions to support people. In fact, your bank, if you have a credit, your bank will send you an email saying to you, let's talk. Let's know if you are able to pay. If you are not, tell us. I'm sure, Kingsley, you would have seen those emails. They are asking customers because they need to be there for customers during these unprecedented times. So if the same is not applicable to Nigeria, and someone, your customer, maybe they have lost their jobs and the ability to repay, it's a problem. You can restructure the credit facility, right? You can restructure the credit facility. You can give them payment holiday until they get back to to work if it's actually customers that were paying before the COVID, because you need to be able to differentiate two types of customers within your loan portfolio: credits, COVID-induced defaults, and actual defaults. So these people have defaulted, it's not COVID-induced. Those people that have defaulted here, the way they deal with them is to pass them to debt collectors. And because it's going to spoil their credit history, nobody wants to go near default at all, right? In Nigeria, it's still a challenge and also an opportunity for the institute, right? To be able to have this sort of conversation with whoever the person is, the government, the regulators, whoever, how to come up with dealing with actual defaults so that you make people accountable to whatever they have promised to do. So they keep to the terms of the contract. But if it is COVID-induced default, there's nothing they can do because they did not anticipate the loss of employment or the loss of income. It wasn't anticipated at the point of entering into that agreement, the loan agreement. So companies, small businesses like yours in the UK are being supported by government. There's what they call the COVID bounce back loan. There's another loan that they call, aside from the bounce back loan that they give to businesses, right, that have been affected by this COVID. They have the COVID, the one they give to small enterprises. Forgotten what they call it, COVID startup loan or something, right? So government has come up with different levels of loan packages with 1 year. These loans are interest-free for 1 year. Then you start to repay in the next, so 2022 is when you start to repay. And the interest rates are ridiculously low, very low. So unfortunately, Priska, in Nigeria, I'm not very sure what sort of interventions will be available to support small businesses that may have sold goods on credit where their customers are no longer able to perform their terms of their credit sales as they fall due. The only thing you need to do is to enter to renegotiate. So you could ask them to, okay, when you get back to job, are you going to continue paying? As long as it's a COVID-19 induced default.
All right. Thank you very much, Dr. Sharma, for that very smart response to the question. Let me say this to all our members, and those who are here can take this to our friends. We know ourselves somehow. The members of our institute, we are trying to see that you are brought into international standards. You can sit in the comfort of your house and get to understand all this. It's very key. What is important is to develop a very strong passion for learning, increased knowledge, versatility, relevance. It's not just about money making, but it's about relevance of yourself. How are you impacting on the community within your workplace, the global community? Therefore, members' participation in the Institute's monthly credit management webinar update generates and promotes diversity of ideas. You know, share the responsibility, professional and business collaboration, academic collegiality, and institutional excellence. That's what we are looking to have. We want relevance wherever you are working. People should be able to ask questions. Who picked you? Why are you so super? Why are you so relevant? Why are you so current? Why are you so up to date? Why do you possess this ability to navigate, looking at scenarios from different angles and providing objective advice to people you report to? So I want to request that we develop extra interest in what we're doing. One thing is to put a program together, another thing is to have people participating. But I think one of the best tricks that we tend to use and keep using is to bring for you people of super relevance, like Dr. Sharma has distinguished herself. Look, somebody sending, Westlat is sending this to you again. Let me read it to you. Say, thank you, Dr. Sharma, for attending to my question on acquiring skills on data analytics. Now, the question is this, Dr. Sharma is shopping the data. Is it possible to replicate the online training being managed in Scotland by you in Nigeria through the institute? You know, have partnership. The institute have partnership with CDAF, and the institute also have partnership with London Postgraduate Credit Management College, where Dr. Sharma is also an outstanding lecturer. And because of my representative nature of the London Postgraduate in Nigeria, I put my feet down and said, Dr. Sharma, you are a Nigerian and I'm a Nigerian. You got to also have a voice in the lecturing platform of the Postgraduate School of Credit and Financial Management. You see the connectivity. so Dr. Sharma will be able to speak wherever you are, as long as this new normal comes in. You know, we're now sitting in a place of comfort, and we're accepting a credible idea, even without paying for it. So whatever it is, we can always develop a curriculum, maybe at the foundational level, at the intermediate level, on data analytics. But you see, one thing I have, which I strongly advise Nigerian people, is you got to invest in your career. You got to invest in acquiring knowledge. It's not going to come to you by mere wishing. It's not going to happen. You got to invest. Two things I tell Nigerians to pay attention to. Invest in your intellectual capacity. Invest in your professional development skill, and then invest in your health. You got to spend money for you to have good health. So these two things, if the middle class and the younger generation can key into it, Nigeria will be much healthier. So do you have any assurance to give to Westlat on her question? Is it possible to replicate online training?
It's possible, Prof. Of course, Westlat it's very possible to replicate what we are currently doing for the Asian and Black minority ethnic women in Glasgow here. And the beauty of this, and one of the, although you don't have any positivity in pandemic of this nature, but one of these, let me say, silver linings in this COVID thing is that it has shown us that you can do anything remotely, right? So when we put in the proposal to do the training, we were thinking of using our physical office, but then COVID happened and we quickly migrated the training to online. And it's Zoom that we use, just like this Zoom meeting, not even Zoom webinar, right? So we use Zoom meeting it's very foundational to teach. We are teaching them Excel first, basics. They'll begin to understand what is even data analytics, different aspects of data analytics roles that exist, because at times we lump these things together. So we started from there, we started to then build their skill sets on how to use pivot tables, very important skill that you need to acquire as an accountant, as whoever, a supply chain, whichever sector you work at. Pivot charts, pivot tables, very important. So now they have successfully, women that came in knowing nothing. In fact, I must confess to you, the first time I met different people that signed up, because I don't see them, it's managed by our community and outreach engagement officer. The first time I met these people face to face and I saw their faces, in my mind, I was saying, wow, this is going to be daunting. How do you teach? Because most of them are elderly, some of them are in their mid-30s, others, very few are young, actually, very young university students, about five of them or so, the remaining. But can I submit to you that today, the dashboard we have asked them to create and to write a report, which is supposed to be due by the 18th of December, most of them have finished that already. So, and these things were done online. So it gives me great, very confidence, because what our request when we put in the application was to upskill the skill sets of ethnic and minority women so that they can start to secure lucrative positions from the sectors that we have serious underrepresentations of this ethnic group. And Rosa Foundation found that very interesting, and they found it very interesting, and they approved the funding. So it will be my greatest pleasure to see at least 30–40% of these women moving from the menial job sector to this sort of roles that are in hot demand. That's just the truth. It's in hot demand.
Yeah, okay. Okay, Dr. Sharma, thank you very much for that interjection. And I look forward to very responsible corporate organizations in Nigeria to come up and sponsor such initiatives. Like you said, you mentioned foundation. That's one thing very clear, because some of these things, Nigerians are generally not keen to investing in their intellectual capacity. And then again, the system hasn't really been able to separate severely financially disadvantaged people, but who are still looking to come up and catch up with other people who have been able to succeed. So they have that huge financial constraint. And what should happen would have been the big name, like the Dangote of this world, like the BOA of this world, like the Central Bank of this world, like NDIC of this world, like the Bank of Industry of this world, and so on and so forth. Coming up, the communication companies of this world, the Glo, the Airtel, the whatever name, you know, they should be able to look at the society and trying to impact, you know, further capacity, not just leaving everything to the government. Yeah. And I think that's the beauty of the developed society. But then we are not too far away from them, because we come there all the time.
Of course.
And we can easily replicate what they are doing for quick development, for quick growth, you know, of the people. Now, I have one question for you, Dr. Sharma. And I was expecting this question to come from operators in the credit bureau industry in Nigeria. We have very strong 3 or 4 credit bureau organizations in the country. Now, you mentioned from the graph, some of the graphs you were showing, you mentioned watch list. And then you were able to connect, look here, induced credit default. I mean, COVID-19 induced credit default. And these are legitimate, you know, category of credit customers that whose businesses were affected, you know, and then their case is understandable. That the providers of such credit, financial credit or trade credit, need to, you know, meet with them and reach a mitigation understanding. But then there are some people who are perpetually in default, which you said by your graph, that put them on the watch list and connect them to debt recovery organizations who will pound them, who will harass them, you know, to get, so that they'll know that you don't just take credit and go and make big man with somebody's own wealth and resources. Now, in Nigeria, there is a huge legal constraint. The credit bureau would have been very nice, because they carry blacklist, if you like, in credit, you know, arena, that people whose reputation has been repudiated, because the moment you default in credit and you found your name in the credit bureau box, your reputation is suffering repudiation very seriously. Now, I want you to connect the role of credit bureau and the watch list. I've lost you.
Yeah, I muted myself. Sorry for that.
All right.
Credit bureau, right, is the lifeblood of any credit economy. You cannot do without credit bureaus. You cannot possibly have an effective credit economy without the credit bureaus. That's just, so let's get that fact very straight, very, very straight. Now, because here in the UK and other places, other parts of the world, not just in the West, because if you look at Namibia, Southern Africa there, South Africa and all that, they have a similar credit bureau like what you see in the West, right? So for credit bureaus, they are saddled with the responsibility of checking and assigning credit history, credit scores to borrowers, right? And then part of their job as well is blacklisting, like you say. And each month they release their credit score, and this credit score is based on the information they hold about the customer, the clients. Now, because of what a low credit score can do to you here in the UK, you don't want to play with your debts. You don't even, if they send you a letter that they are going to pass your debt to the collecting agency or to debt collectors, you are very quick to make arrangements to pay. Very quick, because once they pass that, it has affected your credit ratings.
Right.
So credit bureaus are very important. They are the lifeblood, the lifeline of any effective credit economy. And no matter how we see credit is no matter how we see credit in Nigeria and some parts of Africa, credit is the way to go, because that's what stimulates the economy. At times you may want to get something and you don't have the money immediately, the complete money to get it. You take credit and then pay from your income. Now, because you know that if you default in the payment, it carries severe consequences, because the credit bureau, we know that. Late payment, missed payment, they all have scores in their metrics. So if you make a missed payment without a prior information to the bank or to the credit seller, to the person that has sold on credit, you risk your score being affected. So I don't know if I answered.
Okay, yeah, Dr. Choma, let me, there's just a quick message is coming in on the screen right now, and it's coming from Jamia. Jamia is the CEO of the Credit Registry, one of those very strong credit institutions we have. But to be honest, I think they are the first, to hit the market in Nigeria. They're quite big. And this is what she's saying. She's saying the Credit Registry is here. It's critical. It is critical for every lender to report performance or lack of it. We encourage all COVID-19 induced defaulters to contact your lenders immediately. This will help prevent impact on your credit score. So this is a comment the CEO had just sent in to collaborate what you just said, the importance of credit bureau in the overall credit economy scenario of any country.
Good.
But I think they need to do more. In Nigeria. We want to hear them loud and clear, and we want to see that. Okay, it's on the screen. What have you got to say? Okay, Ray.
Hello.
What have you got to say? Yeah, okay. What have you got to say? We can hear you. Okay, Ray.
Hello.
We can hear you. Go on. We can hear you.
Okay. Thank you so much for the presentation. It's really, really informative. And the best part of it is that we're going to get the slide for us to go through it, because the pandemic has thrown us into a situation where we have to continue to learn and continue to brace up any
Yeah.
And I like the model where she said, in time past, we look backwards, like trend analysis, to see what we're going to do. But any organization, any institute that is still doing that now will be left behind.
Yeah.
We have to project forward. And thank you so much, Doctor. You really inspired me.
Thank you.
You're beautiful at what you do, and I love you. Thank you.
Thank you.
All right.
Thank you very much.
Thank you.
Dr. Sharma, you can go home with that one. You are beautiful at what you do.
Yeah, so thoughtful and kind of her to say that. Thank you.
Yes. Okay. I think we are coming to the end of this conference, and I look forward to wider participation in the future. I can promise you that God on our side and God keeping nations together, we will bring Dr. Sharma again and some other of her colleagues, so many of them that are looking to develop the credit system in Nigeria in collaboration with the Institute of Credit Administration. And I have given my word to her that we'll pull out our members. ICA has over 3,000.
That's massive.
Yes, they're over 3,000. About almost, we're almost hitting 4,000, and about 70% of this number represent top-notch, people who govern corporate organizations. So I think we need to really come. It's not about having too many institutes that you belong. It's about where do you get value, and what impact on the business that you do on a daily basis. So in future, God willing, we are going to be able to bring Dr. Sharma again and some of her other colleagues in the UK, and we also have a lot of them in the United States. So we hope to come your way again. We promise we're going to, as soon as Dr. Sharma sends the slides across, we are going to send it to everyone.
I'll send it now.
Thank you very much. And but don't just keep it. Don't just keep it. Go through it. Connect it to the note that you've taken. Recharge your brain again. Reflect on some of the voices, beautiful voice of Dr. Sharma that you've heard, and then you'll be able to recollect, some of the things that you are going to be able to read on that slide. So I haven't said, Dr. Sharma, thank you once again for your time. Thank you all the participants. We look forward to coming your way again. On the 12th of December, we're going to have our Credit Industry Awards. Unfortunately, Dr. Sharma hasn't been nominated, and I hope maybe because of this, a lot of people will be nominating your name for the award. I never can tell, but anyway, we'll see how that goes. So once again, thank you for your time, and we'll come your way next time. God bless you, and goodbye from Lagos.
All right, thank you. Thank you for the opportunity, and thank you, everyone. Bye-bye.
Thank you, Dr. Sharma. Bye.
Bye, thank you.